Gold and silver just broke out, not with a whisper, with a signal that quietly experienced traders have been waiting years for. Behind closed doors, one veteran dealer is warning that this is not a normal rally. He believes the bond market, the very foundation used to finance the United States government, is showing cracks that most people are not being told about. Somewhere between a coin shop counter and a treasury auction desk, a pattern has emerged, one that has appeared only a handful of times in the last 100 years, and each time it appeared before, it preceded a financial reset that reshaped who held real wealth and who did not. What is happening right now behind the scenes? And why are silver and gold moving in a way analysts say cannot be ignored? Stay with this video until the end, because Part 5 reveals the exact mechanism insiders believe is coming next. Welcome back to Precious Metals Intelligence, the channel built for those who prefer to understand markets before headlines catch up. Whether you have followed this channel for years, or this is your very first visit, thank you for spending these next few minutes here. This is a space for calm, careful analysis, not hype. And today's topic deserves exactly that kind of attention. For weeks, the price of gold and silver had been moving in a quiet, narrow range. Nothing dramatic, nothing that made the evening news. Traders watched the numbers tick up a little, then down a little, and most people outside the industry paid no attention at all. Then, without much warning, that quiet pattern broke. Silver pushed past levels it had not touched in months. Gold climbed right alongside it, moving higher day after day. To an outsider, this might have looked like just another normal swing in the market. But to the people who work with these metals every single day, it looked like something else entirely. One of those people is a longtime coin and precious metals dealer. He has spent decades behind the counter, buying and selling gold and silver from ordinary people, families, retirees, first-time buyers, and seasoned collectors. He has seen booms, he has seen busts, and over the years, he has learned to read the mood of the market not from headlines, but from the people walking through his door. That is what makes his reaction to this recent breakout so important. He was not just watching a chart, he was watching real behavior in real time from real customers. According to him, something felt different this time. Sellers were still showing up in large numbers even as prices climbed. Wholesalers told him they were still being flooded with silver coming in from the public. That detail matters more than it might seem. In a normal, healthy rally, buyers usually outnumber sellers. People get excited, they want in, and demand pushes prices higher in a natural way. But this rally did not look natural. It looked forced. It looked like something was pushing prices up from behind the scenes, even while ordinary sellers kept unloading their metal. To understand why that distinction matters, it helps to look back at history. Gold and silver have always moved together, but not in a random way. For centuries, there has been a rough ratio between the two metals, the kind of natural balance point that reflects how rare each one is compared to the other. That ratio held fairly steady for generations, shaped by trade, mining output, and the way currencies were once physically backed by these metals. But every so often, that balance breaks, and when it breaks, it rarely breaks quietly. The dealer has seen this happen before. He points back to two major moments in his lifetime when the normal relationship between gold and silver fell apart completely. Each time, the shift did not happen because of some small news story. It happened because something much bigger was going on underneath the surface of the financial system. Pressure that had been building for a long time before it finally showed up in the price of metal. What makes this moment stand out to him is not just that prices are moving, it is how they are moving. The pattern reminds him of those earlier turning points, the ones that came right before much larger financial stress became impossible to ignore. He has only seen this specific pattern twice before in his entire career. For most people, a price spike is simply a price spike. They see the number go up and they either feel excited or indifferent, depending on whether they already own gold or silver. But for someone who has spent a lifetime reading these markets from the ground level, a move like this raises a different kind of question. Not how high will it go, but what is happening behind this that we are not being told? That question is the real reason this breakout matters. It is not just about a chart line moving upward. It is about what that movement might be reflecting. Pressure building somewhere else in the financial system. Pressure that has not yet reached the headlines most people read every morning. The dealer chose his words carefully when describing what he was seeing. He did not claim to know exactly what would happen next. But he made it clear that, in his experience, metal does not move like this without a reason. And usually, by the time the reason becomes obvious to everyone, the biggest moves have already happened. That leads to a much bigger question, one that goes beyond any single coin shop or any single chart. If gold and silver are reacting this strongly, what exactly are they reacting to? The answer, according to many analysts, points somewhere few people are watching closely enough: the bond market. Most people never think about the bond market. It does not trend online. It does not fill up news feeds the way stock prices or gold prices do. And yet, according to many analysts, the bond market may be the most important financial market in the entire world. It is the place where governments borrow money to keep running. It is the market that decides how expensive it is for a country to stay in debt. And right now, that market is showing signs of real strain. To understand why this matters, it helps to think about what a bond actually is. When a government needs money, it does not just print it out of thin air, at least not directly. Instead, it borrows the money by selling bonds. In simple terms, a bond is a promise. The government says, lend us this money now, and we will pay you back later with interest. Investors, banks, and even other countries buy these bonds because they are supposed to be one of the safest investments in the world. But safety depends on trust, and trust depends on demand. If plenty of buyers want these bonds, the government can borrow money cheaply. If demand starts to fall, the government has to offer higher interest rates to attract buyers. Higher interest rates mean it costs more to borrow. And when a government is already carrying a massive amount of debt, higher borrowing costs can create a dangerous cycle that is very hard to escape. This is where the story becomes more serious. According to the dealer and others watching this space closely, there have been signs this week that efforts to keep the bond market calm were struggling. In simple terms, there appears to be a quiet, behind-the-scenes effort to manage bond yields and keep borrowing costs from spiraling out of control. Some analysts refer to this kind of activity as a form of plunge protection for the bond market, steps taken away from public view to stop a slow decline from turning into a rapid one. But this week, that effort appeared to fall short. And when protective measures like that start failing, it tends to catch the attention of people who understand how these systems work. One especially important detail concerns who is actually buying government bonds right now. In healthy times, a wide mix of buyers purchases these bonds. Other countries, large institutions, and everyday investors through retirement accounts and savings vehicles. But when that mix starts to shrink and a smaller group of buyers has to absorb a larger and larger share of new debt, it becomes a warning sign. According to the discussion between the dealer and his guest, ordinary members of the public may be shouldering more of this burden than most people realize, often without even knowing it, through the retirement funds and savings accounts they hold. This is not a small technical detail. It speaks to something much bigger. When a government has to work harder and harder just to find buyers for its own debt, it usually means confidence in that debt is quietly eroding. And when confidence in government debt erodes, investors often begin looking for somewhere else to protect their money. That is precisely where gold and silver re-enter the picture. For thousands of years, gold and silver have served as a kind of financial insurance policy. They do not depend on any single government's promise to pay. They cannot be created out of thin air the way paper currency can. When trust in bonds and currencies weakens, history shows that money tends to flow toward hard assets that do not rely on anyone's word to hold their value. This is why many analysts believe the recent breakout in gold and silver prices is not happening by accident. It is not simply a random shift in investor mood. It may be a direct reaction to stress building inside the bond market. Stress that most ordinary investors are not yet fully aware of, because it has not been explained to them in plain terms. The dealer put it simply. When the safest investment in the world starts to look less safe, people quietly begin moving their money elsewhere. And right now, more and more of that money appears to be moving toward metal. But this pattern is not new. It has happened before, in different eras, under different governments, for remarkably similar reasons. To understand where this may be heading next, it helps to look back further than a single news cycle, back to how nations throughout history have handled unsustainable debt, and what usually happens once that pressure finally reaches its limit. History does not repeat itself in exact detail, but it often follows familiar shapes. And when it comes to nations carrying heavy debt, one shape keeps showing up again and again. Analysts sometimes call it debasement, the slow, quiet process of reducing the real value of money so that old debts become easier to pay off. This is not a new idea. It is one of the oldest tricks in the history of empires. Ancient Rome faced it. Ancient Greece faced it. Over time, both began shrinking the amount of precious metal inside their coins, while still expecting people to treat those coins as if they held the same value as before. At first, most people did not notice. The coins looked similar. They still passed from hand to hand in everyday trade. But eventually, the truth became impossible to hide, and trust in the currency itself began to break down. Centuries later, the same basic pattern showed up again in a different form. In the United States, coins once contained real silver. Then, in the 1960s, the silver was quietly removed. The coins kept the same size, the same design, and the same face value. But the actual value inside them had changed completely. People who paid close attention at the time understood what this shift really meant. It was not just a design change. It was an early signal about the direction the currency itself was heading. That is why some families, even back then, quietly encouraged their children to set aside older coins instead of spending them. Not because they expected to get rich, but because they sensed that something fundamental about money was shifting beneath the surface, and they wanted a small piece of protection against it. Fast forward to today, and the scale of the problem looks very different. The national debt is no longer measured in the millions or even billions. It has climbed past $40 trillion with no clear sign of slowing down. To put that number into real perspective, some analysts have tried to calculate what it would actually take to back the entire currency with gold, the way it was done generations ago. The results are almost hard to believe. According to some of these calculations, gold would need to trade at well over $100,000 per ounce just to fully back the currency in circulation today. That is not a typo, and it is not a wild guess pulled from nowhere. It is simply what the math demands once debt reaches this level. At today's prices, there is no realistic way to return to a full, hard asset-backed currency without an enormous and disruptive shift in prices first. This is an important point to understand clearly. It is not that a return to a gold standard is expected anytime soon. In fact, many analysts believe it is unlikely, precisely because it would force governments to stop spending freely, something few governments in history have ever chosen to do voluntarily. Debt-funded spending gives governments flexibility. A hard asset-backed currency removes that flexibility. That is exactly why most modern governments have been reluctant to seriously consider it. But that reluctance does not eliminate the underlying pressure. It only delays how that pressure gets released. And throughout history, when governments avoid discipline for long enough, the financial system tends to find its own way of restoring balance, often in ways that catch ordinary people off guard. Some analysts have pointed to global partnerships, such as coalitions of emerging economies, as possible candidates to lead a shift back toward harder forms of money. But even these coalitions face major obstacles. Their members often have very different economic priorities, different levels of gold reserves, and different political goals. A unified, hard asset-backed currency requires an extraordinary level of cooperation that has proven difficult to achieve in the modern world, even among allies. What all of this points to is a simple but important idea. No single country appears ready or willing to lead a clean, official return to a gold-backed currency. But that does not mean gold and silver are becoming less important. In many ways, it means the opposite. As trust in government debt continues to erode and as the mathematics behind that debt become harder to ignore, more attention naturally shifts toward assets that do not depend on any government's promise at all. This is not just a theory floating in the background. It appears to already be playing out in real time. And it is not just individual buyers responding to it. Increasingly, large and historically cautious investors, the kind who rarely make dramatic moves without strong justification, appear to be positioning themselves early. When an ordinary investor decides to buy a small amount of gold or silver, it rarely means much on its own. But when large, cautious institutions start making the same decision, in large amounts at the same time, it tends to mean something very different. These are not impulsive buyers. They are typically slow, careful, and reluctant to move without strong reason. That is exactly what makes their recent behavior worth paying close attention to. One example involves a well-known investment firm led by one of the most respected names in the investing world, someone widely regarded as an expert in identifying value that others overlook. This firm rarely puts money directly into gold mining companies. It has built its reputation on patience and discipline, not speculation. Yet recently, it significantly increased its position in a smaller gold mining company, adding to holdings it already had. Firms like this do not make large moves like this casually. When they do, it usually reflects a strong, calculated belief that something meaningful lies ahead. That firm is not alone. Another well-known research group known throughout the investment world for being highly skeptical and critical, often searching for companies to bet against rather than support, has also been buying shares in that same mining company. This detail matters because firms like this typically make their reputation by finding flaws, not opportunities. When a group known for skepticism starts buying instead of shorting, it often signals genuine confidence rather than blind optimism. As this kind of institutional interest has grown, so has the value of the company involved. Its market value has climbed steadily, moving from a relatively small and overlooked company to one now drawing serious attention from major investors. Even the company's own leadership has continued adding personal investment alongside a large percentage of ownership already held by insiders and wealthy individual investors. When leadership and informed insiders continue buying, even after prices have already risen, it often reflects confidence that goes beyond simple short-term optimism. Much of this growing interest centers on the company's location. Its primary project sits in a historic gold-producing region of Canada, an area long recognized for stability, strong infrastructure, and decades of proven gold production. Regions like this matter greatly to serious investors because political and regulatory stability can be just as important as the gold found underground. A promising deposit in an unstable region carries far more risk than a similar deposit in a well-established, reliable jurisdiction. Timing also plays a significant role in why this kind of investment is happening now rather than years from now. The company appears to be moving steadily toward production. using a streamlined regulatory approach designed to bring the project online sooner rather than later. For investors, this timing matters enormously. Many mining investments take decades to reach production, if they ever do at all. A company positioned to begin producing gold within the next several years, rather than the next several decades, represents a very different type of opportunity, one that carries far less uncertainty. There is also a deeper layer to this story that experienced investors clearly understand. Beyond the current regulatory pathway lies the possibility of expanded federal permitting down the road, which could eventually allow significantly more of the region's resources to be developed. In other words, informed investors are not only positioning for what the company can produce in the near term, they may be positioning for a future scenario where that potential expands considerably further. None of this happens in isolation. It reflects a broader pattern already discussed throughout this story. A pattern where growing distrust in bonds, currencies, and government debt slowly pushes serious money toward hard, tangible assets. Institutional investors do not typically announce their true reasoning publicly. They simply act quietly and deliberately, often well before the broader public fully understands why. For now, this leaves an important question still unanswered. If sophisticated institutions are already positioning themselves ahead of time, what exactly are they preparing for? What specific mechanism, event, or shift could turn this quiet accumulation into something the entire world can no longer ignore?